A key decision by the Federal Reserve holding interest rates steady for the second consecutive meeting following a string of 11 hikes. So what does it signal for the ongoing battle against inflation? Your bottom line, just with the holiday season upon us. NBC senior business correspondent Christine Romans is here to break it down. We've been watching this delicate dance that the Fed has been doing to try to bring down inflation, but not crash the economy. So what does holding the rates steady again signal for that effort?
It signals that they are making progress on inflation. And that's really important because inflation was issue number one for so many American families. But killing inflation requires another painful truth for Americans, and that's higher borrowing costs. And I think, guys, we have to settle into a period where borrowing costs, interest rates are going to remain high. Higher for longer is the mantra on Wall Street and in Washington. And what that means is if you buy a house, you're going to be able to afford less house than you could just a couple of years ago. An example, say a $300,000 house with 20% down, you're going to pay $700 more a month for that mortgage than you would have just a year and a half ago. So that's real money. You look at credit cards. This is very dangerous. And I think everyone this morning around the kitchen table should understand credit cards are more dangerous today than they've ever been. Those interest rates are 20, 25, 30% for store cards. So that's something to really keep an eye on. And borrowing costs for cars also still higher than they have been in a couple of years.
So are mortgage rates going to remain high? Is that what you're expecting?
So I think you're going to be stuck here. You're going to be stuck here above 7%. And think about what that means for the housing market, everybody, because a lot of people have mortgage rates in 3%. Right? Are you going to sell your house if you have a 7 or 8% mortgage? So you're already seeing home sales start to decline and people kind of sitting tight. I call it the golden handcuffs, a 3% mortgage rate. You don't want to move where you're going to have to pay a whole lot more for interest.
Well, the Fed chair, Jay Powell, actually said the economy was strong.
Right.
And this is the weird irony this whole time is that the stronger and more resilient the economy is, that means he's got to keep this interest rates pretty high.
And it's American families who are the ones who are right there in the middle of what you call the delicate dance, quite rightly. You know, we don't want inflation. We don't want inflation to be too high for too long. That's very dangerous. We still have a very strong job market, though, and the overall economy is still in really good shape. So that's the very good news. But for people who are borrowing money, just borrower beware, especially into the holidays, I think.
Okay. Christine, good reminder about credit cards. Thank you.
Thanks, Christine.
Hey, thanks for watching. Don't miss the Today Show every weekday at 11 a.m. Eastern, 8 Pacific on our streaming channel, Today All Day. To watch, head to today.com/allday or click the link right here.